Yesterday, on December 11th, 2025, the financial world thought it had won. We told the world that the banking cartel had finally surrendered. We looked at the charts and we celebrated, because decades of price manipulation appeared to be over. But today, on the morning of December 12th, the phone lines went dead. I want you to look closely at your trading screen right now. The spot price of silver is sitting at exactly $62.30. It held the line. It did not crash overnight. On paper, looking at your brokerage account, you are richer than you have ever been in your life. But I have a challenge for you. I want you to try to spend it. I dare you to take that $62.30 and try to buy a single ounce of physical silver right now. Go ahead. Open a new tab on your browser. Go to the biggest wholesalers in North America. Pick up the phone and call the major refineries in Switzerland. Dial the numbers for the sovereign mints in Australia. Do you know what you are going to hear? You are going to hear a dial tone that rings into eternity. Or, if you are lucky, you are going to hear a recorded automated message saying, "Due to extreme market volatility, we are currently not accepting new orders." We warned you about this specific day for years. We told you that when the price finally broke the commercial suppression, it would not be a smooth ride to the moon. We told you it would break the internal machinery of the market. Well, ladies and gentlemen, the machine is officially broken. What we are witnessing right now at $62.30 is not a simple supply shortage. Do not confuse this with a standard inventory delay. This is a liquidity nightmare. The global supply chain for physical silver has snapped. Refineries are halting orders. Wholesalers are unilaterally canceling trades that were locked in yesterday. The United States Mint is reportedly on indefinite allocation. Why is this happening? To the uneducated observer, it makes no sense. The price is at an all-time high. Why would they stop selling? Because the price went up too fast. It sounds insane, does it not? You would think high prices would bring more supply to the market. That is how Economics 101 works. In a normal market, high prices incentivize sellers. But the silver market is not Economics 101. It is a leverage-filled house of cards built on paper promises. And at $62.30, the hedging mechanism that allows refineries to operate has turned into a suicide pact. In this broadcast, I am going to explain exactly why the supply chain has frozen. I am going to walk you through the refiner's trap. I am going to show you why having fiat currency in your hand right now is the most dangerous position to be in. Let us define the situation on the ground right now with absolute clarity. Usually, a functional market has two sides: a bid, which is what people are willing to pay, and an ask, which is what sellers are willing to take. When these two meet, you have a trade. You have liquidity. But as of 9 o'clock this morning, the silver market has gone bid only. There are millions of people waving cash trying to buy at $62, $65, even $70, but there is no ask. The sellers have left the building. I received a report this morning from a major contact at one of the largest precious metals distributors in Texas. He told me, and I quote, "We have ceased all sales. Our hedging line with the bullion bank is maxed out. We cannot replace the metal we sell, so we are closing the website until further notice." Think about that. They are in the business of selling silver. Silver is at an all-time high, and yet they are refusing to sell. Why? Because of replacement risk. Imagine you are a dealer. You have a box of silver eagles. You bought it 3 months ago when silver was $30. Today, silver is $62. You could sell it right now and make a profit. But if you sell that box today for $62 an ounce, you have cash. But tomorrow, if silver gaps up to $70, you have to take that cash and try to buy new inventory. But if the price is rising faster than you can restock, or if there is no metal available to buy, you go out of business. You sold a hard asset that is appreciating for a currency that is crashing. So the smart dealers have realized the trap. They are hoarding their own inventory. This creates a liquidity vacuum. The metal exists, it's sitting in vaults, but it is not available to you. This is trickling down to the retail investor. If you go to the major websites right now, look for pre-order buttons with an expected ship date of February 2026. Do not click that button. That is an unsecured loan you are giving to a dealer who does not have the metal. At $62.30, the physical link has been severed, and the reason starts at the very top of the food chain, with the refiners themselves. To understand why the system broke at $62, you must understand the engine room of the crisis, the refineries. Most people think a refinery like Heraeus or Pamp Suisse is a speculator. They think when silver goes up, refiners celebrate. They do not. Refiners hate volatility. Here is how the business actually works. A refinery buys raw ore from a mine. Let us say they buy 1 million ounces. It takes time to refine that silver, maybe 2 weeks. The refinery is terrified that the price will drop during those 2 weeks. If they buy at $62 and it drops to $50, they lose $12 million. They would go bankrupt. So they use the futures market to protect themselves. The moment they buy the physical ore, they go on to the COMEX and short an equivalent amount of paper silver. This is called a hedge. If the price goes down, they lose on the physical but make money on the short. If the price goes up, they make on the physical but lose on the short. They are delta neutral. They just want to earn the refining fee. This works when silver moves 10 cents a day. But what happens when silver moves $5 in a single day? You get the margin call. The refinery holds the physical metal, but it is sitting in a furnace. It is not cash. But their short position on the exchange is losing millions by the hour as the price spikes. The exchange demands cash immediately to cover the paper loss. This is the nightmare. The refinery is solvent but illiquid. On Wednesday, December 10th, when silver ripped through $60, every major refinery got a phone call from their broker. Send $50 million now or we liquidate your position. Refineries do not have that kind of cash sitting around, so they panic. They stop buying raw ore because they cannot afford to hedge it. And if they stop buying ore, they stop producing bars. This is why the supply chain halted. The high price blew up the hedging mechanism. It's a paradox. The higher the price goes, the less silver gets produced. At $62, the capital requirements are 5 times higher than in 2020. The refineries are paralyzed. Until the volatility stops, they will not produce a single new bar. So the refineries are frozen. What happens to the wholesalers? These are the companies that buy industrial bars and melt them down into coins for you. They are the bridge to the retail investor. When the refineries halted orders, the wholesalers panicked. I spoke to a source at a major minting facility in Florida just 2 hours ago. He described the atmosphere as apocalyptic. He said, "We have orders for 500,000 ounces from retail customers. We took their cash, but our supplier just canceled our delivery. We are short 500,000 ounces. We are technically bankrupt if we cannot source the metal." This is the dirty secret of the bullion industry. It runs on just-in-time inventory. When you buy from a website, they often do not have that specific bar. They order it from the wholesaler, who orders it from the refiner. The chain is broken. The wholesaler has 2 choices. Choice 1, refund your money. You get your fiat currency back, which is losing value. Choice 2, delay shipping. This is the allocation email happening en masse today. It says, due to unprecedented demand, your order is delayed 4 to 6 weeks. Translation, we do not have the silver. We are praying the price drops so we can find some. They are selling you a promise, not a product. While the wholesalers are sending apology emails to retail investors, the industrial buyers are swooping in. I am talking about the titans of industry: Tesla, Samsung, First Solar, Raytheon. These companies do not buy 1-ounce coins. They buy the 1,000-ounce commercial bars directly from the vaults in London and New York. And at $62.30, they are not hedging. They are panic stockpiling. They see the refinery freeze. They know that if the refineries stop producing for a month, their assembly lines stop. Think about a solar panel factory. It costs billions to build. It runs 24 hours a day. If the silver paste runs out, the factory shuts down. The workers go home. The stock price collapses. The cost of shutting down is infinitely higher than the cost of silver. So these companies are not waiting. They are bypassing the entire supply chain. We are seeing reports that Samsung and LG are directly approaching mining companies to buy run-of-mine production. They are offering to finance the mines in exchange for guaranteed delivery. This is the phase we call unobtainium. Unobtainium is a term for a material that is perfect for the application but impossible to get. When a commodity becomes unobtainium, the price creates a vertical wall. It does not go up 10%, it doubles. Then it doubles again. We saw this with rhodium in the year 2020. Manufacturers panicked because they needed it for catalytic converters. The price went from $2,000 to $29,000, a 14 times increase. Why? Because without rhodium, they could not sell the car. So paying $29,000 was a bargain compared to bankruptcy. Silver has just entered this phase. The industrial user feels FOTO, fear of trading out. This is a much stronger emotion than FOMO. Wait until Apple announces a delay in iPhone production because of silver shortages. Then you will see what a real mania looks like. But there is a darker layer to this story. We have to talk about the geopolitical checkmate. We have to talk about why the vaults in the West are empty. For the last 3 years, while Western markets suppressed the price, the Eastern powers were draining the physical metal. I am talking about China and Russia, the BRICS nations. They saw this coming. They knew the Western banking system was leveraging paper silver, so they played the long game. They used the Shanghai Gold Exchange to create a vacuum. Every time the price was smashed down on the COMEX, China was there to buy the physical bars and ship them east. We have tracked massive outflows of silver from London vaults to the east for 36 months. It was a silent raid. While Western investors were distracted by tech stocks, China was cornering the strategic metals market. Why? Because they know silver is the petroleum of the 21st century. You cannot build a green energy future without it. You cannot build high-tech weapons without it. By controlling the physical stockpile, China effectively controls the manufacturing capacity of the West. Today, December 12th, that trap has sprung. The Shanghai premium, the difference between the price in China and New York, has exploded. This acts like a magnet. Any remaining silver in the West is being sucked into the East. This leaves the Western industrial complex naked. The United States government has no strategic silver stockpile. We sold the last of it decades ago. So now when Tesla needs silver, they're competing with China. And China is saying, no, we need it for our own missiles. This geopolitical tension turns a financial crisis into a national security crisis. The shortage is not just about money anymore. It's about power. And when governments feel they are losing power, they change the rules. This leads us to the inevitable response from the empire. The regulatory hammer is about to drop. Now we have to talk about the regulatory war. The empire is about to strike back. Do not think the central banks will let silver go to $100 without a fight. They have lost the free market war, so now they will change the rules to save themselves. The most dangerous concept right now is force majeure. It means superior force. In the fine print of almost every bullion dealer and futures exchange, extreme market volatility is listed as a valid reason to declare it. What does this mean for you? If you hold unallocated silver, futures contracts, or ETF shares, and they declare force majeure, they do not have to give you the metal. They can settle your contract in cash. Imagine silver hits $100 next week, but the bank settles your account at the last closing price of $61. You lose $40 an ounce instantly, and you lose the asset. This is perfectly legal. It is the ultimate trap for those who do not hold physical metal. We saw this happen in 1980 with the Hunt brothers. The exchange instituted liquidation-only orders. It became illegal to buy new silver contracts. You could only sell. This artificial selling pressure crashed the price. We are likely to see this again within days. Here's the playbook they will use to try and break the price at $62. First is the margin nuke. The exchange will raise margin requirements overnight. If it costs $10,000 to control a contract today, tomorrow it might cost $50,000. This forces small speculators and retail traders to sell their positions because they cannot afford the deposit. Second is position limits. The Community Futures Trading Commission will declare a market emergency. They will cap the number of contracts any entity can hold, claiming that speculators are hoarding a strategic resource. They will likely exempt the big banks, keeping the game rigged. Third is the ETF betrayal. Watch the SLV Trust closely. They might suspend the creation of new baskets. This disconnects the ETF from the physical price. You might own a share trading at $50 while real silver trades at $80. When these regulations hit, the price on the screen might dip. Silver might drop from $60 to $55 on the news. The media will scream that the bubble has burst. Do not fall for it. Regulations cannot print silver. Margin hikes cannot create metal. Taxes cannot manufacture bars. All these tactics do is kill the paper demand. They do nothing to solve the physical shortage. In fact, when the government steps in to manipulate the market, it is the ultimate proof that the vaults are empty. So, despite the halted refineries and the regulatory threats, the math is inevitable. We are currently at $62.30. Here's exactly how we get to $100. Stage 1 is the gamma squeeze, taking us to $75. This is happening right now. Market makers are forced to buy futures to hedge against millions of call options. It's a mechanical buying loop that will push us through the 60s within days. Stage 2 is the public mania, taking us to $85. At $75, silver hits the mainstream evening news. This brings in the herd. People who know nothing about finance will panic buy because they see the price rising. This momentum pushes us to $85. Stage 3 is industrial capitulation, taking us to $100. At $85, companies like Tesla and Samsung stop fighting the price. They issue bonds to buy physical metal at any cost to keep their factories running. This institutional buying breaks the final resistance. This brings us to the most important question: when do you sell? You have held for years. If silver hits $100, do you sell? My answer is no. You do not sell silver for dollars. Why would you trade the scarcest asset on earth for a currency that is collapsing? If silver is at $100, it means the dollar is dying. Selling for cash is buying a burning ticket. The strategy is to swap. You play the ratios. Strategy 1 is the gold swap. When the gold-to-silver ratio drops below 30, you swap silver for gold. You trade volatility for stability. You lock in your purchasing power without touching fiat currency. Strategy 2 is the asset swap. You trade silver for land. You trade it for real estate. You trade it for a business. In 1980, you could swap roughly 800 ounces of silver for the average American home. Today, that ratio is still skewed, but when that ratio returns, you exit into productive wealth. Thursday, December 11, 2025, will be remembered as the day the illusion broke. The supply chain has snapped. The window has been boarded up. For those of you holding physical silver, you are your own central bank now. Do not let the volatility shake you. Do not let the government headlines scare you. The banks have lost. The industry is panic buying. Hold the line. Protect your stack. The greatest wealth transfer in history has officially begun.